The Federal Reserve on this day just made its first double size rate hike in 22 years. It lifted the benchmark range from 0.75% to 1%. This increase is twice the size of the quarter point hikes typically used by the Fed, and it seems to be underscoring the Fed's view that inflation remains something of a threat. Here to talk about all this is Ben Winck. He is an economy reporter for Insider. Ben, what was your reaction to the Fed hike?
Well, first off, thanks for having me, David. This was pretty much what we expected. The Fed has done a pretty good job under Chair Jerome Powell at sort of hinting that, at what policy decision is going to come next. He had said before this meeting that it was on the table that they would do this double-sized hike. And so, markets, economists, they're all kind of expecting this, right? Because we saw inflation go to a 41-year high in March, and we still have been adding jobs at a really solid pace. And so, this is really an indication from the Fed that they see the labor market continuing to recover at a really solid pace, but that inflation is just too high, and they're going to have to be a bit more aggressive with slowing down demand, slowing down the economy a bit, just to rein in that price growth that's really posed a problem for Americans for about a year now.
And that price growth, has that also been a problem for Wall Street and corporate America? And the reason I ask is, and this maybe also gets to the idea that the Fed had been telegraphing that there would be these rate hikes. What explains the fact that stocks seem to be doing so badly for so long this year?
A lot of it comes from uncertainty around not just the Fed, but how the Fed's policies are going to affect the economic recovery. On one hand, this was a welcome sign for markets. The day of the rate hike, or the 50 basis point rate hike, stocks were up, and then it wasn't until the next day that they erased all those gains and tumbled. So it's a bit of a mixed bag for markets. On one hand, they're seeing that the Fed is taking this inflation problem seriously, and markets don't want to see inflation bring us into a new recession. At the end of the day, inflation poses a serious economic risk. If people stop spending money, companies' profits don't grow, and people might stop spending money if prices keep climbing. So on one hand, that's one way to look at it, or at least one way that markets have been looking at it. On the other hand, raising rates, especially at this more aggressive pace, that does take away some of the economic support that markets were cheering throughout the pandemic. So they're really just digesting this news. That explains, some of the volatility that we've been seeing, not just over the past week, but really throughout 2022. And markets are still not convinced that the Fed can raise rates and really nail this perfect landing, which is when you can kind of tame inflation, but not pull the economy into a recession, right? Not see a jump in unemployment. So whether the Fed can achieve that remains really uncertain. But it does, that uncertainty is why markets are up a lot one day and then stocks are tumbling the next.
I keep hearing this soft landing, the idea of like a perfect landing, where, as you pointed out, yes, they're able to tame inflation, but we don't go into a recession. And I've heard a number of leaders suggest, there's probably a 1 in 3 chance that they're able to nail this landing, but there's also maybe a 1 in 3 chance that this sparks a really severe recession. What's your view on it?
I think I'm taking that other 1/3 chance where I think we're going to see a recession, right? A technical recession, which by definition, at least from the government, it's 2 consecutive quarters of negative GDP, negative economic growth. I think we will see that. I think we'll see growth really slow down, turn slightly negative. We already saw that in the first quarter, but that was more because of some technicalities just with how GDP is calculated. I think growth over the past, or at least over the first quarter, was pretty strong. We've seen that in the jobs reports. We've seen that in consumer spending data. But I think this is such we use the word unprecedented all the time, right? But coming out of a pandemic like this, with the amount of economic aid that we had over the past 2 years, and with households' balance sheets doing pretty well, right? And the economy, at least the labor market, rebounding at a speed that we just haven't seen in decades. That's we don't really have a precedent to look back on and say this worked, this didn't. This is just a really unique situation. So I do think that the landing won't be the perfect soft landing that we would all hope for, right? I think there will be a small jump in unemployment, just because the Fed's really going to have to tap the brakes on the recovery quite hard, just because inflation is not just really high, but it's been stubbornly high. And I think they want to bring it back down to healthy levels, and not just over several years, but really quite quickly, because at this moment it's just too high and not sustainable. But I don't think
by bringing inflation down through something of a rate hike, it also though causes people who are looking at mortgages or home loans or car loans to see their interest rates go up. Will there be that sort of direct correlation, and how much will consumers start to feel that end of this?
We've already started to see some of it. Mortgage rates have been climbing, have already hit decade highs, and the speed that they're climbing at, I should say, and that's been the really remarkable thing. We haven't seen mortgage rates climb this fast in modern history, at least going back several decades. So, on that front, yes, it's getting harder to take out a loan, to buy a house. Car loans, credit card interest, or paying down your credit card debt, that's going to be harder for sure. But that's part of the Fed's bid to say, this is going to tamp down demand, and that's what we need to do to get our strained supply back in balance with this demand that has really been overwhelming over the past several months.
It's overwhelming that, in fact, some economists have suggested that maybe the Fed has been acting too late, that the time for a rate hike might have been, a quarter ago or 6 months ago. Any thoughts on that?
Yes, I do think the Fed is a little late, but hindsight is 20/20, right? And I think what we've seen in this recovery is the Fed, instead of prioritizing keeping inflation low, they've really prioritized the labor market's recovery. And I don't know if we would see the same jobs recovery, this really amazing jobs recovery that we've had, if the Fed didn't wait this long. If they started raising rates earlier, yes, maybe we wouldn't have the high inflation that we have today. I think we still would have fairly high inflation, just because so much of it is from these supply chain issues. But I don't think we would see this really amazing, just super fast-paced hiring recovery that we've seen. So, it's tough, right? You have to pick between the two, and the Fed made its choice. But this 50 basis point or double-sized rate hike, that really is emblematic of the Fed saying, okay, we've seen the labor market recover really well. We really need to take this inflation problem not just seriously, but more seriously than we have been, and start to rein it in at a pace that we haven't seen, like you mentioned at the top, for 22 years.
I'm so glad you mentioned the jobs recovery and the ability of people to sort of switch jobs and new jobs being created. The other factor in all this is a lot of people are concerned about the wages for jobs. I mean, there's been a dramatic increase for working class workers seeing their wages go up. Now, perhaps still not keeping up with what people at the top are making, but nonetheless, what impact does a rate hike have on sort of working class wages in general?
I think it's a bit of a mixed bag. On one hand, it is going to make certain things, any kind of borrowing, more expensive, right? Because you're paying more interest on the debt you have or what you borrow. So if for working Americans who are deciding to get into the housing market or to get a car, and they're getting loans for those kinds of purchases, it's going to be more expensive. But on the flip side, the labor shortage is going strong. Job openings and quits were at record highs in March. That really just goes to show, people are moving around, like you mentioned. They're getting jobs with better pay or better conditions, and companies are still really desperate to hire. The sort of the easy estimate, the loose estimate is that there are 2 job openings for every available worker. So it's really it's a worker's job market right now. If we can see inflation start to slow down because of these rate hikes, but the labor market is still that tight, we might start to see real wages, inflation adjusted wages start to hopefully turn positive, and see buying power actually grow. Because over the past year, yes, there's been very strong wage growth, but like you mentioned, inflation has just eaten away at that for most workers.
And does this all suggest that regardless of the tinkering at the Fed, whether you want to call it tinkering or something more dramatic, that the basic the basic parameters of the U.S. economy still seem really strong. It still seems like the U.S. economy is firing in all cylinders right now.
Yeah, that's the tough part is that on one hand, yes, inflation is really the big economic problem right now. Compared to when we had the Omicron wave and the Delta wave, COVID cases are slightly on the rise, but really it's inflation that's really taking that center stage as the big economic issue. But like you mentioned, yes, spending is up. The jobs recovery has been fantastic. We're still adding jobs at a very fast pace. And data we had this morning might have been the first sign that inflation peaked in March. It slightly slowed down, at least in the early April CPI inflation reading. So yes, the economy is doing extremely well. And what the Fed is doing is trying to slow down the recovery so that inflation doesn't really erode the recovery that we've already had. If inflation stays this high, we could be in this a new kind of crisis.
And for everybody out there, I mean, consumer confidence is also another sort of key factor in determining whether the economy is whether people are out there spending or not, and that's key for the economy. So to everybody out there, stay confident, keep going, keep this economy going. Ben Winck, he's an economics reporter for Insider. Ben, good of you to join us to explain this stuff. Thanks for being part of the conversation.
Of course, thanks so much for having me.